Hello traders, it's Saturday, March the 1st. This is John Kicklighter, Chief Strategist for dailyfx.com, here to give you your FX market wrap-up for this past week of trading and an outlook for what we can expect in the week ahead. This past week ended with extraordinary volatility with a very sizable push in particularly the U.S. equity markets, finally getting us above that 1850 level, and with doing so with a little bit of gusto. However, the complications with finding follow-through, the complications we've talked about on a number of occasions over the past weeks, remain. The conviction that we need to just continue a drive, whether it be bullish or bearish, has yet to really instill itself, and these very sharp moves are keeping us wide open to potential false breakouts and a lot of possible reversals. So the S&P 500 is a good reflection of the very active markets, but at the same time the lack of follow-through that we're still struggling with from a trading perspective. Because seeing breaks like this normally engages a lot of people into their breakout strategies. And a breakout strategy is looking for some level of confirmation, whether you're talking about a small spot move above a particular level or beyond a particular support or resistance, and then going for and trading some follow-through. However, it's that follow-through that makes us the money at the same time as the follow-through that we're really struggling to generate. Now, I covered the risk concerns that I have more in detail in this weekend's strategy video. I recommend you check that out if you want to see generally the approach I'm taking. It's more of a shorter term trading approach, and I'm really reserving the opportunities for medium to long term. Very few medium term opportunities truly out there, and even fewer long-term opportunities. But that's just the nature of the market. Because when I look at a fundamental perspective of these capital markets, all right, we're met with the reality that this drive from the S&P 500, but it's not just the S&P 500. It has its implications, particularly in other risk scenarios like the euro-yen or all the other yen crosses. And truly, it has its influence over just anything that has a sensitivity to risk to some degree or another. All right, and you can see here are my standard benchmarks for risk, and they've all put in for some significant progress, especially over the past couple of years. Even the EURUSD, which, as I've noted a couple of times in the strategy videos and in the trading videos, that this is a currency pair that is not very attuned to risk trends. In fact, if you want to get the EURUSD moving on the foundation of a risk-based drive, it has to be some severe level of risk, whether risk appetite or risk aversion. It has to be pretty severe. Otherwise, that risk theme is not going to spill over, and if that's not going to be a risk-based drive, this EURUSD move, especially if we're trying to call a breakout to the upside, because this is not a small break that it would be made. It would be a multi-year break. It would require some kind of driver, a fundamental catalyst. If we don't have that catalyst, this is going to be very prone to losing its momentum almost immediately after the break, after a number of people are drawn in to try to take advantage. So these risk conditions, these underlying market drivers that would keep us going to the upside are very, very dubious. I see this technical move, and yes, this makes sense, especially from a probabilistic standpoint of view. We know that a 5-year trend is more likely to guide the market for a little bit longer, and that's exactly what's happening here. But seeing momentum, all right, seeing the consistency and the drive, the new fundamental capital inflows that would support such a move's continuation, that's the difficult part. Looking at a couple of factors. These are some of the factors that I covered in the strategy video. We have something like the S&P 500 versus the volatility index. All right, volatility is certainly a measure of risk and fear, but it's also a gauge when we flip it upside down, which we have here, and see how it produces moves to the upside. As we unwind that risk premium, it means more people are drawn into the capital market. All right, because as that risk evaporates, it encourages new money in because there is, quote-unquote, some kind of bargain to be had. That's not going to be the case here because we are at some level of natural low, or at least very, very, very close to it. We don't have that deleveraging that would give us a new sense that the market is all of a sudden providing some substantial bargain. All right. The outlook, if you want to go even more basic in terms of economics, fundamentals in terms of growth, fundamentals in terms of yield, fundamentals in terms of financial stability and capital flow around the world. Those terms do not look like they're going to improve substantially, especially not in the degree necessary to feed a new multi-hundred-point rally from an S&P 500 or to feed a couple thousand-point rally in some of the yen crosses, much less something that is more stubborn like the EURUSD making a very material drive itself. All right. Now, this does not necessarily mean that I'm not going to trade with risk. I can trade with risk, but my trade time frame is going to be much shorter. I'm not going to go for a multi-week trade that's risk positive. I'm going to go more for a couple of days or maybe a week at a most, and I'm going to keep that stop relatively reasonable. And I'm not going to trade in full size because fundamentals are not aligning to these technicals. But at the same time, if I see a reversal, I'm going to have to be much more skeptical because the persistence of this market is just too difficult to fight against. What is driving this market, you might ask? Well, though participation might be exceptionally low, though there isn't much in the way of risk premium to unwind and bargains to be found, there is still a very interested market out there that's looking to take advantage of this persistence. They're trying to take advantage also of the early adopters for a reversal that continuously get knocked out, and as they cover their position, we climb a little bit higher. This is showing itself in a very extreme way in the leverage that we have here. This is the New York Stock Exchange leverage. It's been updated through the end of January. You can see that leverage has hit a further extreme, and man, is it growing at a rapid pace. But a lack of participation, markets having to further stretch themselves to support the highs that we already have. These are not the circumstances for a robust backdrop. Now, this is very much an equity perspective, but you do have that same sentiment in other risk-sensitive assets. Now, when the equity market, when it does start to pull back, it has all the conditions of a massive reversal and potentially a disorderly one, which you might not see in something like a EURUSD, which is only a couple thousand pips off of its long-term trend line low. But you will nevertheless feel a risk aversion drive. The problem is instigating a drive that is deep enough and suggestive enough that it disrupts sentiment across the board, not just in one asset class. And that's always been the case of what we've been talking about in our risk sensitivity curve, the risk depth. All right? We need to turn that volume all the way up and drown out every other concern that the market might have. Now, this push into the end of the week from the S&P 500 is very provocative. It's going to draw a lot of people's interest, and of course the fact that we haven't really seen a strong follow-through in the yen crosses, the euro yen, the pound yen, all right, the dollar yen. These pairs have not shown a very strong coincidence with that move, which they should. All right, if this were truly a risk-based move. Furthermore, we have global equities are not matching that pace. Nikkei 225, the German DAX, FTSE 100, you can look at all the indexes. They are at various levels of height, but they're not at the record highs and showing that new ambition that the S&P 500 does. What's the saying from the nail that sticks up the furthest? It's the first to get hammered down. All right, so it's the standout, the S&P 500. That is a concern. That is a very big concern. Now, you could always find some level of confidence from the underlying fundamental backdrop to support this move, but as of right now, those circumstances are not there. So it's still a very tall order, a very tall task to get us continuously moving in favor of risk-based trends. Furthermore, and over the weekend, keep a very close eye on the events unfolding in the Ukraine. All right, I haven't really talked about it a lot over the past week, but we have covered it somewhat in the emerging markets discussion. The Ukraine is in the vacuum left by the government that was just disposed. We have something of a standoff between Western world and essentially Russia, and this is going to be a very, very significant source of tension from the global financial perspective and the global political perspective. That's going to create some problems for stability in the financial markets. And when you have something that's based on record amounts of leverage, you can't write off such concerns. All right, this is not an easy situation to resolve, so we'll see how this develops, especially into the opening 48 hours of the coming trading week. But this risk theme has a lot of different potential catalysts, a lot of different propellers for getting that movement, getting that volatility going. And remember, since we were looking at the U.S. dollar and we have pulled back to some very substantial trend line lows, all right, remember what the circumstances are for the U.S. dollar. Its influence, its performance, is typically reflective of volatility. If we get some level of volatility, it's more likely to support the U.S. dollar. Okay? So, in that risk aversion, which I don't really want to peg the U.S. dollar too simply as a safe haven currency, because we haven't really seen a strong need for the safe haven currency. Of course, it might come to that eventually, but that's more of an extreme circumstance. But nevertheless, the dollar can still perform on some level related to this overriding concern. And it can do so through this relationship here, volatility. And volatility itself, as we can see, can move outside of just a measure of up or down for the S&P 500. It truly measures the level of activity in the market and uncertainty as well. But we can see the U.S. dollar here, and if we do have a rebound in volatility, which is it's a decent probability, especially considering the lows that it continues to kind of bounce along at, expect the U.S. dollar to gain some traction if that pickup does come. And subsequently, if we pick up some traction from the U.S. dollar, I'm going to be very, very interested in what's going on with the EURUSD, which has come up to that 138 level, and it's come up, and doing so, it's come against some major technical resistance and a multiple Fibonacci retracements, trend lines, wedge tops, and at the same time, extremely low levels of activity. All right, ATR, which is a good stand-in for volatility, as you can see here, it's extremely low. For those that follow contrarian readings, this is definitely a contrarian reading where we are seeing something that is flashing a warning sign that it's going to turn into a breakout. The question is which direction. A number of people have already asked me that. This is not something that you want to try to preempt. All right, this is not something to just jump in now and hope for the best. You want to see that confirmation. You want to see what the fundamentals are behind it and to make sure that they are feeding that technical break. But we need to see that technical break first. We need to measure the fundamentals that will support it and follow through. That's very, very important, especially for trying to find a break on something with this magnitude, because you can see the picture, the size of the chart that we have to look at to really get a full sense of this setup. This is years worth of price action. So subsequently, to see a breakout, you would think that this is not a breakout that will last hours. This is a breakout that potentially lasts weeks. All right, and if that's the case, remember what our conditions are. These are not good times to trade those medium to long-term trades. All right, not unless a significant development in fundamentals comes along. So we still do not have those fundamentals. We have to be very careful. The fundamentals can come, whether it be risk on or risk off, dollar short or dollar positive, but we have to make sure they're there. Otherwise, we're going to be taking trades that are low probability and essentially based on hope, and very likely to show us a possible breakout, and then could very easily stall. Something that the S&P 500 reminds us of at least a couple times a week. So outside of the risk themes, which we'll be watching very closely, what else should we be looking for? Well, the EURUSD is a very good measure of other fundamental themes as well. In fact, it's not a very good risk gauge unless you're really talking about full-scale risk movement. But this is going to be a very interesting pair for some of the top event risk in the coming week. This next week's docket has fewer items than last week's, but the influence of those items is much more substantial. From the U.S. side of things, be very careful, more so on Tuesday, which is when things really start getting interesting, where we have the Senate banking hearing, confirmation hearing for 3 possible Fed nominees. All right, and essentially they're all going to be voters this time around. That's going to be Fisher, Bernard, and Powell. All right, we want to see not just whether they're going to get the okay from the Senate, we also want to see if they have a hawkish or a dovish leaning. We know that the Fed is essentially in status quo mode. They are set in their pace, they expect to taper, and the burden now lies in the data changing that pace. And as even Yellen has said, it's going to be a difficult pace to change. So we want to see what their commentary is. Is this necessarily a big driver for the U.S. dollar? Probably not. All right, not alone, at least, because as we've seen over the past couple of tapers, which are these purple lines here, or these red lines, we really haven't seen a lot of dollar reaction from that. This would, in turn, this confirmation hearing, really speak to the pace of that taper and eventually to the timing of a Fed rate hike. But that Fed rate hike is still significantly into the future. All right? So we've already had the market pricing in through swaps an interest rate hike for some time, and it really hasn't maintained the U.S. dollar's buoyancy, much less that taper conversation. All right? So merely looking at the Fed speakers is not going to be enough. We need to put into context. We need to make sure that the market's actually moving on their taper interests. All right. The other major top of interest that we have for the U.S. Dollar is going to be the non-farm payrolls. More importantly for me, the U.S. unemployment rate. All right. These figures come on Friday, as you well know, and that is going to be the kind of event risk that taps into monetary policy expectations. Recently, we've seen a little bit of the dollar taking a beating because, in part, there is a belief that the taper will actually be stalled sometime in the foreseeable 3 to 6 months. That might be a little bit overblown, but if that's the market's growing concerns, if doubts are starting to spill over, we're seeing that influence the U.S. dollar. All right. In terms of what dollar-based pairs look really good for these kind of circumstances, the EURUSD is certainly one of them. We'll talk about this one specifically in a second, though, from event risk perspective, because the ECB rate decision coming up on Thursday is going to be much more influential. But also keep a close eye on the pound dollar. All right, attempting to try to get back above that 168 level, or at least test it. This is very much a monetary policy versus monetary policy currency pair. All right, the interest rate forecast for the British pound has been set. It has generated a lot of strength for the sterling, and at the same time, the markets have recognized that they might have gone a little bit overboard those expectations. Now we need to see if they can actually be retraced, or if they will be retraced. All right, but this will be more a judgment on the dollar side than it is the pound side, and we have seen price action drop off pretty heartily in terms of the volatility measures. So we have to be very careful about what to expect here. This is going to be an interesting currency pair, particularly from that event risk perspective. Dollar yen is going to be influenced by risk trends, but as you can see, the dollar's influence has been checking this somewhat. We have not seen a strong risk-based move, not like the equity indexes at least. And the Aussie USD, this one is in tight congestion. Once again, this has great potential in the dollar event risk, but it's probably not going to be the main catalyst for this particular setup, not even non-farm payrolls, right? Because the Aussie data is probably going to spill in a little bit more aggressively than the U.S. data. I even have a dollar Swiss position. All right. Now I've laid this out in Friday's strategy video. Why I like the dollar Swiss. I took the position, and it wasn't necessarily a good time for it. It seems because it did drop pretty sharply. I'm now, I think, 50 pips in the red, but that's okay because this is more. Well, it's not okay, but it's more of a medium to long-term trade. My reasoning for this position was explained pretty thoroughly in the video the strategy video, but this is much more a longer-term setup in its relationship, the dollar Swiss, to the euro Swiss, which we know has a natural floor under 120, as well as the dollar Swiss relationship to the euro USD. They have a good inverse correlation, and my expectations for the euro USD are pretty asymmetrical. They're imbalanced. I think there's far greater potential to the downside than there is the upside, and even if it does trend higher a little bit, there's always that euro-Swiss relationship that will come in with that 120 check. All right, so you can look into that interest a little bit more in that strategy video. I also am interested in this Kiwi dollar. I'll be watching this one on the open next week. As you can see, we've had once again interest and hold at that 84 mark. This is a descending channel, but more importantly, this is more congestion. Longer term, medium term, and even short term, congestion seems to be the pace. So if congestion is the prevailing theme, then finding a strong technical resistance is definitely something of merit to potentially setting up an interesting trade. So I'm going to be watching this as well. Now, these are the dollar interests. My top interest, though, in terms of individual currency pairs has to be the EURUSD. This thing is well positioned for a medium to long-term breakout, but of course, as we've suggested, you have to have the circumstances align. You can't just have a technical move and then everything fall into place. You have to have a technical move with the fundamental drive to actually find follow-through. All right, you have to get all of those elements in place to make it a meaningful trade, because I'm sure many of you have come across very great-looking technical setups, and they put in for a breakout and they subsequently just stall immediately afterwards. All right, you don't have to look very far for something like that. The S&P 500 has been a great example for this on a constant basis. All right, it has not been able to generate the necessary momentum for reversal to the downside. It has not been able to generate, as of yet, the momentum to really feed a move above 1850. All right, and that's because it doesn't have those fundamental backdrops, those drivers to actually keep it going. For the EURUSD, we talked about the dollar side of things and that this is a breakout candidate. Dollar interests are there. The just general risk theme isn't really a big catalyst here. This is one currency pair that it's very difficult to tap into that particular vein. But we do have some very critical event risk from the euro side of things. The whole reason this euro, or the biggest reason that the euro rallied this final trading session of this past week, and this wasn't just a move for the EURUSD, we had it against pairs like the euro pound. All right, we definitely saw it in the euro yen, although it wasn't able to break its trend congestion pattern. We had it in the euro Aussie, nice little breakout there. This was one that I was talking about particularly for a possible move to the upside if the euro are going to get a rally. And the euro Kiwi, nice channel hold, all right, and a move to the upside. All these euro-based pairs were moving on the particular event risk this past session, or Friday's session, which was the release of the unemployment rate and the CPI data. That data, that combination, is essentially the statistics that the ECB looks to when it's determining its monetary policy. And it's a very timely event release, because next week we have the ECB rate decision on Thursday. The unemployment rate remained at a record high. It was the inflation figures, particularly the core figures, that were very interesting. We had a tick up from a multi-year low, unexpectedly. And that peels away some of the pressure, relieves some of the bears' influence, and helped lift the euro a little bit. All right. But how much is actually priced in here? That's something we'll go into more detail next week as we get closer to the ECB rate decision. And I haven't had to change my ECB policy options all that much to account for what the expectations are and how this can these markets can respond. But this Thursday rate decision is certainly going to be very influential. The markets are more skewed to the ECB doing nothing. And the fact that if they did do nothing, would we get a really strong euro reaction? Probably not. There's not that much priced in. On the opposite end of that spectrum, if we do see something that is deemed easing, a rate cut or a stimulus program, that would have far greater influence on the euro itself. All right. That is, once again, an asymmetrical fundamental consideration. We don't have a very strong risk responder here. The U.S. dollar's interests are really heavily weighted to Friday, so this is a very remarkable currency pair individually, this euro. But there are more pairs that we can look to. There are many euro pairs. We just looked through a number of them. They have great potential, and we'll have to keep an eye on them. The other really data-loaded event risk, or data-loaded currency this coming week, is going to be the Australian dollar. All right. The Aussie dollar, which we have here, the Aussie USD, nice potential inverse head and shoulders. If it wants to make a bid of that 90.80, or if it wants to break back below 89, we have a possible catalyst to get it going. Now, this currency is typically considered a high-yielding or investing currency, and thereby is driven oftentimes on risk on or risk off. Now, you know my concerns with risk trends. They don't have a strong push. So that might lead many of us to believe that the Aussie dollar or many of the other Aussie crosses are going to be a struggle over the coming week. But that's probably not going to be the case because the relationship between the S&P 500 or other measures of risk trends and the Aussie dollar itself has really diminished over the past months. All right, perhaps the best influence that we've had from risk trends is the Aussie yen, and as you can see, it's not really following that theme whatsoever. All right, so we do have a particularly interesting situation with this Australian dollar, and I played the Aussie dollar off this reversal here, but I did not play that break to the downside below 91, and that's because the event risk that we have in the upcoming week is just too dense, and it creates a lot of uncertainty. Starts off immediately when we have the Australian inflation figures, all right, which are not necessarily top tier, but they will influence the market. Then we get into the real stuff, the current account balance and the RBA rate decision. Very important, the rate decision come Tuesday. And then we get into the Aussie GDP on Wednesday, and then we follow up with further event risk through Thursday and Friday. But keep your eyes to the front of that week, right? Because not only does the Aussie data come across the wires, but we also have the Chinese National People's Congress, which is where they will give us an update on growth for 2014 targets. We will get an update on the 2014 budget report. All right, we'll get a good sense of China. And where the Australian dollar has not been very good at following risk on, risk off, it has been fantastic with following China. All right? And China has become a very interesting story where we do not necessarily see funding pressure in China anymore. You have seen the 7-day repos in China, which is flipped upside down here, has eased back to multi-month lows. But at the same time, we've also seen the Chinese yuan has dropped for 9 consecutive days. That's the longest run for the yuan to drop since way back in 1995. All right, so there's something amiss. This is probably a reflection of the People's Bank of China trying to curb the capital flows within the country, and this is not necessarily a good time to do that. You disrupt this risk-positive run that we're trying to get on the S&P 500, which has not fully developed or evolved into a global risk-based move. It threatens to stall this out, and regardless of the ability to keep that movement going forward, that level of volatility can remain. And if we don't have that forward momentum, it's much more likely that we can suffer a reversal in risk trends and really start to see these markets move in the opposite direction. Right. There's a lot going on next week, and a lot of complicated themes. And it's complicated not because there are many of them and that they're complex, but they're complicated because the fundamentals and the technicals are not doing very well to align to each other. All right. This is going to create a difficult situation and some difficult trading, especially for trying to force medium to long-term trades onto positions. It's better to look for the shorter time frame trades and to play nimbly and keep those prevailing trends in mind, but at the same time, remember what the fundamentals are that you should be looking for. All right. If you have to look at two things, I always recommend that you look at the S&P 500 and the US dollar, or if you want to look at the S&P 500 and the EURUSD, because these two will encompass a lot of the bigger picture items. Right? Mull on this and establish a strategy for how you're going to approach next week. It's good to go in with a strategy and to execute cold and calculated, because the emotions are probably going to run hot next week. In the meantime, have a fantastic weekend, and I'll wrap you up on these markets once again on Monday.